8 commercial banks in Nigeria are now too big to fail. That according to a draft report released by the Central Bank of Nigeria. Well, this means that if one or more of these lenders run into major financial difficulty, the entire financial system could be in jeopardy. To mitigate this, the CBN is planning new rules to ensure that these lenders are well protected. Adesoji Sholanke, Sub-Saharan Africa banking analyst at Renaissance Capital, joins me now in the studio to unpack this for us. Thank you so much, Soji, for taking the time out to join us. Well, let's start with the criteria that the CBN used in determining that what bank is too big to fail. Let's start with that.
Okay, the first thing here is the idea of too big to fail is actually a global phenomenon since the financial crisis. And what the central bank has done has actually been more to look at what the Basel Committee was saying. There's a Global Financial Stability Board as well. So they came up with certain recommendations which the central bank has now adopted for Nigeria's domestic environment. From that viewpoint, the central bank looked at a couple of criteria. The size of the banks, how easy it is to substitute those banks, how interconnected those banks are, and also the complexity it would be if you had to dissolve such an institution. Based on that criteria, it ranked the banking system, the different banks, and it chose the big 8. And I think the important thing to note here is this is the first list of banks called the big 8, if I can put it that way. On a rolling 6-month basis, the central bank actually plans to review that list depending on where you rank at any particular point in time. So there's actually a possibility that one of those banks could actually fall out and another one replaces it in that particular list. I think the easiest criteria to analyze from our perspective is on scale, where the central bank cut it off at 5%. So if you control more than 5% of total assets, you are classified as a bank that is too big to fail. For example, people would ask why an FCMB or Fidelity Bank isn't on that list, given how big they are in the Nigerian banking context. But from my viewpoint, if you look at the numbers, the difference in market share between FCMB and Skybank, for example, is just about 1 percentage point. That's 4 to 5%. Okay, so clearly from that viewpoint, you probably think FCMB should be on that list. But like I said, the CBN obviously has more data than we do. So from their viewpoint, they've come up with this list, and it's a rolling and a potentially changing list going forward.
Okay, now what does this mean for the capital of these banks, the capital adequacy ratio? We know that there's 10% for local banks and 15% for banks with international operations. But for you, what would be the biggest impact?
The thing here is, if you're on this list, your minimum requirement is 15%, base case. However, the central bank has done some additional things. It's added something called the higher loss absorbency ratio on top of that, which is an extraction from Basel III, okay, the capital buffer. So that's been added onto that, and this should also comprise entirely of Tier 1 capital. Also, in terms of your capital mix, prior to now, you could have as much as 50% of your capital as Tier 2. Going forward, if you're on this list, you must have at least 75% of your capital as Tier 1 capital. So in addition to having 16% minimum CAR, 75% of your capital must be Tier 1. So for banks like a Diamond Bank, for example, which over the last 18 months has been looking to raise Tier 2 capital of a significant magnitude, going forward, there's a high probability they will have to raise Tier 1. That's a simple fact.
That's for Diamond Bank?
For Diamond Bank.
Okay.
There's also, for a bank like UBA, they don't particularly have capital constraints at this point. But if you look at their mix as at FY12, they have 34% of their capital as Tier 2. Depending on whenever the central bank decides to implement this policy, they will then have to think about around how to move the capital mix around.
Okay, well, let's talk, because this too big to fail theory, because it basically asserts that because some banks are too big and too interconnected, any risk at all or any failure on their part will lead to a systemic failure of the financial system, and therefore they must enjoy the support of the government and the regulator. Doesn't that bring up the moral hazard issue, whereby the banks could decide that, okay, yes, because they know that they will have the protection of the government or the regulator, they could also, they could go ahead and take bigger risks or incur bigger risks, as it were?
The reality is this regulation doesn't particularly grant these banks any special protection from the central bank. It doesn't. It actually increases supervision. Regulatory requirements are also stiffer from the central bank's perspective. And from CBN side, it's more to reduce, because prior to now, if a bank should fail, the typical loss resolution from a central banking perspective was either the NDIC, and eventually you see shareholders losing their investments. From the CBN's angle, is now trying to avoid such a last case scenario to ensure that regulation itself was super tight at the get-go, such that even if such scenarios do realize, from a central banking perspective, you have a better handle on controlling such a situation.